Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It will help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Today, we're going to have Volume 2 of Inside the Spread, where we take a look at some of the recent news, trends and kind of other things going on in private credit, structured credit, fund finance. And within private credit, we'll be covering both direct lending and asset-based finance. And I think, it's been a really, fascinating start to the year. And there's kind of, I touched on this a few weeks ago when I talked about at the end of 2025, some of the headwinds and tailwinds. And it feels like there's like this constant pull, back and forth in a lot of these markets. You have such good news, but then coupled with negative news or negative trends. And I think the last couple of weeks you've seen that. I was out last week not feeling well, so I wasn't able to do an episode. But since I last spoke to you, there's been this massive explosion of fundraising still going on, especially in the private credit or mostly direct lending space, at least the announcements I've seen the last few weeks. But then you have this dichotomy of continued negative trends, negative news. So on the one hand, you have the market that seemingly is not slowing down, though if you look at the overall numbers, 23 to 24, 24 to 25, and now 25 and 26, there certainly has been a bit of a slowdown overall. But I think one thing is clear. Blue chip names are continuing to acquire capital at pretty rapid paces. And the overall market continues to expand. But I think in 26, you'll see it expand in a little bit of a different dynamic. The other thing, the first thing I really wanted to kick off with, as we'll get into a few different topics, secondaries, some fundraising news, some good news, some bad news, the proliferation and the kind of the expansion of evergreen and interval funds, and then a couple of odds and ends as we wrap up here. But I think the thing I found most interesting the last couple of weeks is in the secondary space. So first you have one of the pioneers of secondaries, Collar Capital and Jeremy Collar being acquired by EQT. And so, you have EQT looking to obviously expand rapidly. They could continue to kind of grow at the pace they're growing at, source their own deals, but acquiring Collar gives them this ability to kind of rapidly jump up in the market, now become a leader in the market, which is where certainly Collar has been. While Collar's growth and profit has not been growing as fast lately, I think this gives EQT the ability to really rapidly expand their secondaries practice. I think I read that Jeremy's going to stay on and it'll kind of operate under the EQT umbrella for now, but more as an independent entity. But I think it shows you a few things about secondaries, and I'll go through a couple other pieces in a minute here, is that the sector itself is heating up rapidly. And that's both from a competition standpoint. More funds are being raised by secondaries funds. New people are getting into secondaries, new fund managers, existing fund managers with now secondary strategies. And then obviously, the competition fundraising is just up. And so when you look at secondaries, it's really taking off. And there's a few, I think, structural things that are taking place in the market right now. One, I think, is related to what you've seen, with the volatility and some of the announcements coming out of the current administration here in the U.S. They had certainly the tariff announcements early on, some of that abated, and then you all of a sudden you have announcements related to single family homes. Then you have announcements related to credit card interest, and then you have the Greenland issue back on the front burner. And really, folks are and LPs and investors are looking at a lot of these different announcements or different signals from the market and also from the administration and saying, hey, what can we do to maybe balance a bit away from the US? And I think that has helped play into a greater role for secondaries. I had in the wrap up for 2025, which obviously if you saw on LinkedIn, we were posting some interesting stats. And Rick Jane at Pantheon had the most listened to episode, at least on Spotify. He's pretty close with Phil Totolo as the top episode ever. But his message to me was just how fast it's grown from like 5 years ago to today. And I mean, it's grown, I think, five, six, seven times, if I remember correctly. And this is only playing into that wider trend. And I think there is a lot to say. And there was a piece in Bloomberg this week um, that there are a lot of well-known blue chip names that are looking to get out of their how much they're weighted in the US. They're not obviously going to exit the US entirely, but I think they're seeing this opportunity of, hey, we can rebalance a bit towards Europe. Europe has all of a sudden become a more appealing opportunity. There's some stuff going on elsewhere, Middle East, Asia, but I think Europe's kind of jumped up certainly to be number two, and I'll put UK in kind of the Europe umbrella. And so, I think there is this feeling that if some of this stuff is going to continue coming out of the current administration, then maybe we need to just balance ourselves a bit better. And you're clearly starting to see that. And secondaries is a natural way to do that. And then you're seeing other managers start to really jump into this market in a huge way. PGIM announced this week, they're putting more than 1 billion to work in the secondary space. And so I think, PGIM is clearly another signal that, those who might be in, more in the primary market have seen, hey, there's a big opportunity here. And some of these trends are probably not short-lived. And so if they're not short-lived, where is our strategy around this market? And then finally on the secondaries piece, also related to our friends over at Pantheon, and this is not the core part of the secondaries market, but a growing part. Especially I've heard from various GPs and LPs the last 6 to 8 months, and that was the announcement from Crescent Capital that landed more than 3.2 billion for a continuation vehicle, and they're basically rolling one of their portfolios into this new fund. Pantheon led the transaction alongside the German insurer Allianz, and that was the largest continuation fund to date. It was 3.2 billion that went into continuation fund, which is obviously part of the secondaries market, taking assets that are obviously well-performing assets and moving them into a new vehicle. And I'm sure there's probably some original investors that have gotten liquidity. Someone like Pantheon comes in, probably provides them liquidity. I don't know the details of this specific transaction, but I think it plays into that wider trend amongst the secondaries market that it's not going to be, hey, this is a short-term strategy and here's what we're going to do with it. I think some of these signals are longer term, and you've seen that with a pretty stagnant M&A market, that the longer the M&A market is gridlocked and we don't see this huge swell of deal-making activity happen, then secondaries and continuation vehicles and other different types of structures are only going to gain momentum, and that clearly is taking place here. I wanted to to move to the fundraising bit next, you had some of the biggest of blue chip names raising just, you know, boatloads of capital. The past few weeks, you had a big piece in the Wall Street Journal about Churchill raising 16 billion. Now, some of that includes leverage. That plays right into their core strategy, which is either mid-market private equity sponsor-backed companies and obviously lending to them, as well as the lower mid-market. It was interesting reading the piece. You saw Ken Kensel had said that the competition is actually more fierce in the lower mid-market today than what is considered quote unquote core mid-market. And I think the piece had somewhere between 10 and 100 million EBITDA as kind of what they define as core middle market today. So interesting piece that about the lower middle market there. And we're hearing chatter and interest amongst our conferences that the lower middle market is becoming more of an interesting place today. And you're starting to see a lot more innovation and a lot more creativity down there. And I think certainly that plays right into what Ken was talking about there. Some other interesting ones I think that certainly caught my eye. Monroe raising 6.1 billion. Ares taking in 7.1 billion. And these last two, I think we touched on a little bit earlier, but just to round out kind of what I saw talked about amongst the Churchill, Monroe, and Ares fundraisings was Benefit Street and Davis and Kempner taking in 3 and 1.1 million billion, respectively. And so it shows you that the negative signals, which certainly were pretty strong in the latter half of 2025. I'd say more Q3 than Q4. I think Q4 things died down a little bit, but it shows that those that are performing well can still raise large sums of money, and those that aren't might struggle. And I'm going to have an episode out next week with the author of the Credit Crunch newsletter, and we talked a little bit about kind of that dynamic of well-known large firms, blue chippers, the dynamic against brand new managers, which they are exceedingly small amounts of these days. And then what happens to the ones in the middle? And where is the M&A play there? There's certainly going to be more acquisitions. Who dies off? Who gets acquired? Who merges into each other? I mean, I think 2026, while you might not see the traditional M&A take hold, and what people might think of traditional M&A, I think you're going to start certainly seeing a lot more M&A amongst various private credit fund managers, as kind of the haves and have nots kind of maybe kind of split with one another a bit more. And some of the blue chip names continue to acquire both capital and talent and assets. And I think we're going to continue to see that play out as we move into end of Q1, Q2, and the latter half of 2026. The other, I think, fascinating thing that you're starting to see, and this kind of plays the fundraising angle as well, is just this proliferation of evergreen funds. And this ties somewhat into the administration's announcements about 401k plans, and really um, the moving down the capital kind of train, and looking at, okay, we've exhausted maybe some of these large pension relationships or big insurance companies. We're moving down to high net worth, very wealthy individuals. But then what's that further, name and further accessibility down the spectrum? And certainly 401ks and everyday retail. I know they call high net worth retail, but I think really the everyday person is where there is a big push to figure out A, how to access them, and then B, how do some of these structures play with that audience, and then C, do the investors understand what they're getting and the liquidity, illiquidity question. And I think there's a lot to unpack there. And a lot of it, I don't think, has really been fully vetted out by the current administration and whether or not, what ultimately will be their rulemaking and some of the regulatory issues around it. But I think you're starting to really see like, hey, these large institutional relationships are not always going to come back to the party. Yes, with some names, they're going to be very consistent with that. But I also think for those maybe in the middle funds and even some of the lower funds, smaller funds, they need to find different access points of capital. And the large names will always go to safety, and they see BlackRock, Blackstone, Ares, KKR, etc., as safe. They're large. Their track record speaks for itself. And so, if you're a newer or smaller manager that doesn't have that same cachet, you need to think of different ways to access pools of capital. And so I think this could be one way that they do that. And clearly, if you look at some of the numbers, and some of this I think is provided by Cliffwater, and I believe this is a Bloomberg article that I read. So I want to give proper attribution there. But interval vehicles, which is a type of evergreen fund, held about 92 billion in assets end of third quarter 2025, and that data was from Cliffwater, and that's up from 15 billion in 2020. So that's, do the math, 15 times 4 is 60. So that's six times bigger in 5 years. And last year the article pointed to some Preqin data as well, saying that it just fell short of the record 43 evergreen fund launches, which was back in 2023. But clearly, the push for evergreen and interval vehicles is a big one. And I think it only plays to the broader comment I was talking about, which is the money's got to come from somewhere for these fund managers. The largest names will probably be synonymous with the largest names, but they also want to access liquidity from the high net worth and also retail names. I mean, if you look at the fundraising that was done by Churchill, the 16 billion, that was 325 institutional investors and high net worth investors, or what they call retail investors. So that's 325 LP relationships there. Now, continue to expand that amongst the thousands of funds that are out there. I mean, there's always so many institutions. So I think that plays into, hey, what are some of these structures that we can begin to implement, that we should implement? And I think you're seeing, this market was not always known to have the blue chip names in it. And today, especially in 2025, almost all of those names I mentioned a few minutes ago, KKR, Ares, Blackstone, BlackRock, etc., all have these vehicles now. And I think there's a specific reason for that. And so I think that trend is clearly going to continue in 2026 and well beyond. And so, that, I think is something to keep an eye on. And it's something we're certainly keeping an eye on, not only here at the pod, but also at our conferences. So you'll see a lot more coverage of that, in the coming weeks and months. And hopefully I can get some of these managers on for you to kind of talk through what some of these trends are. We have some conversations going on with them now. So stay tuned. You're not going to hear just me on the pod, though. I appreciate the continued support because we're still seeing strong interest from a lot of you that continue to stay with us, even if it's just me or if it's with guests. And we have 3 great guests lined up over the next few weeks, and we kind of bounce between some of the stuff we've been talking about the last few weeks and this new feature inside the spread. We're also going to launch a new feature next week with the Credit Crunch blog. And then we have some cool stuff, some crypto and DeFi. And so we're trying to get into different areas of the private credit market. Everything itself is going to be relatable to credit in some way. So stay tuned for that. A few other things I wanted to touch on in today's volume of Inside the Spread. One is the good news in the private credit, direct lending markets is, some of the largest investors have yet to be spooked. Mubdallah's CEO was on CNBC this week, also on Bloomberg. I think it was all done from the Davos event, and he basically reinforced their support. While there obviously has been bad news around the private credit space, he thinks their private credit investments have so far shown strength, and so they are not backing away from the sector at all, which certainly reinforces, some of the things we were talking about earlier with large institutional investors and fundraising, which clearly Mubdallah does a lot of allocating to the market. He also mentioned the AI piece as well. AI has been a big topic amongst the investment community the last couple of years. If data centers have taken off, as well as technologies, ChatGPT and Claude and Grok and others. And so when you have someone of the capacity of Mubdallah and the name recognition of Mubdallah, it's good to see that they're not backing away and really rethinking about, hey, should we be allocating more to this space? They seem to be pretty strong on, hey, we've made investments, the investments are performing well, and we're going to continue to make investments in these markets. The other thing I thought was interesting, and I touched on it right at the top, which is the growth in the direct lending market. We're coming up on hitting 2 trillion in 2026. Estimates are by the time we hit the end of the decade, and probably a little bit before, because some of these estimates go into 2029, so a 3-year horizon, say that we'll hit about 5 trillion in capacity for direct lending, and that's by 2029. And I'd probably use the end of the decade and say we'll be over 5 trillion by then, which clearly shows that this market is not slowing down. Maybe different piece of it will. Maybe there'll be a bit more selectivity amongst investments or lending decisions, given the bad news of the past 6 to 8 months. But I think overall, there's not going to be a large slowdown in this market. And there's a lot of companies that need capital for a wide variety of reasons, and that's both sponsor and non-sponsored deals. And so, I think seeing the projections of where this market continues to head, and ABF is a total another side of the private credit market that is growing probably even faster than direct lending market, but I haven't seen as crystal clear numbers for that yet. There's still a lot of conjecture around the ABF market of, hey, it's 20 trillion, 40 trillion. I think we need to see a little bit more, probably by end of Q1, of like how 2025 did to really get a better handle on maybe where that piece of the private credit market is today. But obviously, the capacity of where we're going in direct lending is pretty large. And I think that continues. And unless something dramatic happens in the economy, I don't think there's going to be this wholesale slowdown in the market. On the flip side, though, there are still some negative signals to be wary of. If I was, if you're an investor in the space, or even just kind of looking at the market, from afar, a few things that I think caught my eye this week were obviously the news about BlackRock taking a 19% hit to their publicly traded middle market lending fund. I think it's TPC. You could double check me on the exact name, but that clearly shows that not everything is rosy in the market, and there's a couple of specific companies in there not doing well. I believe one is filed for bankruptcy. So even the blue chip names have suffered a bit. Everyone knows about what happened with Blue Owl and trying to combine a couple of their BDCs back in October, November timeframe. So there are still pockets of stress and negativity, but I still believe the overall market is fairly positive. The other piece I think is really interesting and worth keeping a very close eye on is the element of banks and the easing back of regulations. And what does that mean when it relates to private credit? The OCC was quoted this week of talking about the easing of the bank regulatory rules, and that they can better compete with private credit funds. I'm still pretty wary that banks want to go back to competing directly for the end borrower. I think they're more likely to continue to where they have been, which is lending to the fund itself, providing leverage, being kind of that step or two removed, still active, but underwriting a fund instead of the individual loan, underwriting a platform instead of the individual loan. I think that's where banks have found themselves to be more comfortable and frankly still making probably boatloads of money. But I think going back to, hey, someone's going to come into the bank and we're going to give them the loan. I think the companies that are looking for that at this point have maybe passed the point of, hey, we can wait for a bank to underwrite us for 3 to 4 months. We can go to a private credit shop and probably get the money in a week or two with, fairly, I'd say, if not 100% guarantee, like pretty close to like, hey, we're going to get this capital. The unknown of a bank underwriting, and anybody who's had a mortgage knows this. I mean, it could take forever. I know you get your initial, hey, you're approved for this capacity, but there's so many intricate details to how a bank underwrites someone, as there is with private credit shops. Don't let me, kind of let you think that they're not underwriting these companies in a significant way. There are, but there has been some problems, just like there has been some problems with a lot of the bank lending markets. But I think it's clear that banks, while getting some regulatory relief, I don't think are just going to all of a sudden jump in and say, hey, we're going to compete with Ares on a deal. We're going to compete with Blackstone on a deal. Maybe it happens every once in a while, and some of the banks have obviously launched their own direct lending platforms. I see it's a bit of a far cry from where banks are today and how they've reorganized themselves post GFC to then kind of reformat to go into a market to be on the front line of the lending decision again. I'm pretty skeptical. And I know that the current administration is certainly trying to ease bank regulations. I just don't know if that'll change the wholesale behavior of banks. It's certainly worth keeping an eye on. I think more than maybe some of the other negative signals in the market. This could potentially be negative for private credit funds, especially if banks are actually competing with them in deals and doing it in a way that is almost as fast in terms of time to fund and money out the door as a private credit fund. So wait and see on that. A couple other things I wanted to touch on. One thing in particular, if anybody who knows my background, and I've mentioned it before, I used to run a large fintech conference. We saw this week Brex, who is a small business fintech card issuer, got a data provider, really made a name for themselves in, the small business lending and small business, banking space, sells to, Capital One, probably for a few different reasons, founder cash out. Um, the other thing I think is the wider and more existential question around the fintech business model, which is initially we're going to take the bank's lunch, and then, hey, we figured out we can't take the bank's lunch. Let's partner with the bank. But partnering with the bank and our cost of capital, as well as our marketing cost to find borrowers, is so high. The spread is so thin. Can we become profitable? And then it becomes a scale game. Can we reach a certain amount of scale? So I think there's a lot of innovation still that has happened in fintech, and I think they've transformed a lot of the experience of getting a loan, you know, making an investment, getting your spare change and rolling that into an investment vehicle, and a lot of these other slick, really cool, great gamification, getting people to understand their money a bit better and know where their money's going and all these things. But I do think the fundamental problem of costs and the lack of you know uh, availability of capital cheaply, because banks obviously have cheap deposits, has really, really eaten into what a fintech long-term business model is. And I think you're going to continue to see this. Two of the most successful fintechs that have transformed themselves in the last few years have been both SoFi and Lending Club, who acquired banks and basically turned into banks. PayPal has obviously taken off, Square taken off. Part of those success stories certainly are related to scale. And I do think the fintech model has to continue to be looked at. It's really hard to lend money when your cost of capital and marketing costs are so high, and then get a meaningful return in terms of profitability on that. And if you're not scaled, then you have to be super niche and be able to have that margin be big enough. I think it's still very much an open question. I'm curious to see how much AI can help some of these companies to cut down on cost, both finding borrowers as well as internal costs. And does that keep the margin big enough where they don't necessarily have to sell themselves to a bank or become or acquire a bank? Because I know there's some that still believe in some of these business models. With that being said, thanks for stopping by again. This was Inside the Spread Volume 2. We'll be back next week with a new feature. I interview the author of Credit Crunch, Substack or blog, whichever you want to call it. So me and Nick, it's a fascinating conversation. We had a lot of fun. We just recorded it yesterday. But until next time, thanks so much for stopping by, and we'll see you soon. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.